Good afternoon, everyone, and welcome back to the weekly market analysis for the week ending February 10th. And as we look at the markets, we're pretty light on data this week. Just a couple of little things in the U.S. With the initial jobless claims, which I'll talk about in just a minute. Some international data, some international news relating to the Bank of Japan and the successor to Kuroda, and some China inflation news and things of that sort. But obviously what we focus the most here is data in the United States and on technical analysis. So we're just going to jump right in, but I just want to take a moment to remind you to hit the like button and subscribe to the channel if you're not already, and share the channel with somebody if you think the content will help them. I want to remind you that you can follow me on Twitter at Mr. J. Thomason, and you can follow my Substack at befinanciallyfree.substack.com, and the links for both my Twitter and my Substack are in the description below. Don't forget to check that out. I have a free weekly issue that comes out every Sunday morning, and like I said, it's absolutely free. So if you subscribe today, you can check out the issue that's coming this Sunday. So we're going to jump right into the markets. And actually, before we do, I'll take a quick look at some data. I'll pull up. I don't have the fancy slideshow like I've had before. I just want to show you an update to the jobless claims. We did have jobless claims tick up this week. This is the data of consequence as it relates to the non-farm payrolls. So I'm highlighting it because the payrolls report and job situation is obviously elevated now in the Fed's eyes as far as a data point for how long they're going to continue to tighten for. But I do want to show this on the screen because you do see on the left side you have initial jobless claims, and we did tick up to 196,000, still well below the pre-COVID average, higher than last month. This is going to be the number to watch over the coming weeks as we pay closer attention to the payrolls report. We definitely want to note whenever possible that if we see this number, this blue bar, if we see it continuing to trend up and up and up, then that's obviously going to be the leading indicator for seeing the payrolls report actually showing the number of jobs decreasing, the unemployment rate increasing, and of course that has implications for weekly hours and average hourly earnings and things like that. So we do want to pay attention to that. See also an uptick in the continuing jobless claims on the right side, ticking up just slightly to 1,688,000 on continuing basis, but also still well below the pre-COVID average. So definitely the key that you want is you want to see for it to make any sort of meaningful difference, you want this the blue bar to be up above the lavender bar for a period of time, and it's not, and that's the reality right now. So put that away, so the jobs report didn't really produce anything of significance, although it did contribute to an increasing in the 10-year yield. And I'm starting off in the 10-year Treasury yield because that is kind of the big story this week. Is that the yields are increasing, and this is kind of counterintuitive to what a lot of people have assumed about the markets. And I just want to, if I can, I have this this white line, this white vertical line you could see on the screen. And the reason why I have that highlighted is because on Twitter today, I linked back to an old tweet in response to a fellow FinTwit guy on Twitter. I was drawn to this chart that I had posted in response to a tweet where I said I'm of the opinion that we get one more move higher above 350. Not a popular view. So that was obviously, we had a big spike in yields that day, and I was interacting with some people on Twitter saying, hey, I think we're going to get above 350, which at the time was the old high on yields. And so the reason why I highlighted that is because if I go back, I posted on January 19th that I said this week I'm feeling similar to the way I did in that tweet reply. And I note the chart. And I've been saying this a lot lately. It's lonely. It can be lonely out on the limb. So it's easier to be part of the crowd and to join into what the crowds are saying. But I feel personally that I was, from my view, I was one of the only ones that was out there at the, near the lows back in July, or I don't remember where exactly that was. That was in August. I'm sorry, August 2nd, August 1st and 2nd. I feel like I was one of the only ones back there at that time that was talking about yields making a higher high. And I just want to remind everybody, looking at the yield chart, all the different points in 2022 where people claimed inflation was peaking. So we started hearing the inflation peaking narrative late February, early March. Obviously, that didn't happen, and yields went up. And then after the June report, I think it was either June or July, we started getting we got that 9.1% print, and everyone's like, oh, inflation peaked, and we're going to see inflation declining, and that's going to lead to cutting or pausing and pivoting, and all that stuff. And that was obviously part of that period of time where markets made the highs or made the big bounce in the summertime. And obviously here on August 2nd, on the tail end of this candle, I was saying, hey, I think yields are going to go higher. And then, of course, look what happened. We did. We went up near, almost to 4.3%. So I've got this on log scale. Sorry. So I posted again on. I indicated here in January 19th, according to this tweet, saying something very similar. Basically, that I'm feeling similar to the way that I did in this tweet, because right here, for a long time now, once we got this bounce and it got faded, everyone's saying, yeah, yields are going down, yields are going to go down. Everyone's been pointing at it. And I feel like I've been one of the few that has been kind of saying, no, I think yields can go back up. Now, I don't have the same conviction that I did back, on this August tweet where I was saying that I thought yields, I'm not sitting here saying, oh, yields are going to go up to 450 or 4.4 or 4.5. I'm not saying that. I don't have the same kind of conviction. Because I think the further up that we go, it becomes harder and harder to be bullish yields. But for now, as you can see, we just closed in market condition green. And so that's actually a very bullish sign. You can see that the candle is green, so that's bullish momentum. And you can see that the line here on the week has closed green. So we're bullish on all of the most important fronts. And so if we just go back to all the other times that the indicators went from a yellow, if you just think about the background, we've got green here, yellow here, yellow here. If you go to all of the other instances where we had green, where we went to a green transition on all fronts, that was back in August, right? After being in the middle of this yellow section where that low occurred. And I feel like the same thing has been happening here. And so I'm just pointing out that I believe that we are going to be headed higher for some time. Now, obviously things don't happen in a straight line, so this thing could, come up, come back down and retest there and then take off. And I imagine, that's entirely possible. And what a lot of people will be watching, this level around, 3.8, 3.9. And the reason why is because people will be watching to see if it makes a higher high from our previous high. So you're going to get, if price comes up to that level and then comes back down, on the way back down, you're going to see a huge, you're going to see a ton of people buying, piling into bonds, thinking that the yield is going to continue to come off and that the bond itself will continue to go up. And I think that would be the trap. I do think bonds are going to end up coming up. I think probably where I would say now is maybe around 4 would be a target point. But obviously anything could happen. So like I said, I've got no firm conviction on that. But I do want to call that out because that's the big story these days. And a lot of people are wondering what that means for asset prices. And at the same time, I want to look at the DXY because, I'm showing you kind of I guess I would say I don't have, just like with yields, I don't have the same conviction that I used to have. about this. But just to kind of recap, what's happened basically since September. I tweeted on Friday, September 23rd, at the end of the or towards the end of the day, if you have dollar long positions, you need to close them out. You need to take profit, because I was getting signals that this was at the point of exhaustion. And then what I did personally was, I sold, I took profits and trimmed and various things like that. And then as we persisted on the exhaustion signals, I continued to trim until I got out of my dollar longs. And then we came off pretty hard. And then when we came down here to around this level, so let me actually do this better. When we came down to that spot, I nibbled on a couple of long dollar positions, and then that obviously bounced, moved the stop loss to break even, and then we ended up coming down, so I got stopped out at break even there. And then I tried here because that was coming just at the top of where the July peak was. Took another nibble there, same kind of setup. Price really moved up, moved the stop loss to break even, and then it ended up getting stopped out again. And then after that, I took one more right about there, and that one immediately got stopped out at loss. And ever since those three things happened, I took those three trades to the long side on dollars, and then basically went neutral. And that coincides with this yellow area right here. I was neutral, thinking that maybe this exhaustion was going to take place for some time. And then basically what I've been watching for is for when the dollar was going to become bearish. And I don't actually think I have the trend line anymore, but there used to be, you guys would have seen if you've been following my channel, we basically had a trend line. Let's see if I can do this in real time. I apologize. Basically, it was something like this, and we were coming down closer and closer to that. We did close below it, but then we popped back above, and I wondered if we were going to catch the support here. And you notice too, it coincides with the red background on the chart. And what I'm just pointing out is that as soon as we came up and then closed back down and firmly came down below that trend line, I posted on Twitter and I said, well, now you cannot be dollar neutral either. You have to be dollar bearish. That has to be your bias. And of course, people will point out yeah, that's really late to become bearish. But then also, there was nothing in the macro that would confirm that any of this was any sort of sign of the dollar is now going to be in a long-term bearish trend. People were just reading what they wanted to read, because you have to remember that in all of 22, as the dollar was coming up, it was a wrecking ball and assets were coming down. And so you can't mistake the fact that you can't get confused. Just because the dollar's coming off doesn't mean that there was anything in the macro that was actually changed. And you have to understand that people wanted the dollar to come off because people wanted risk assets to go up. So anyway, I'm recapping that because the conviction is bearish, but the euro positioning has been so extensive that I've been expecting for some time to get a little bit of a bounce. And you can see I actually have these three dotted lines, downtrend lines. And to me, I think this is the channel, the downward channel that has been established. And we were kind of fighting for a couple of days with the center line here. And today we closed above it. So what I'm thinking is probably going to happen now is I think we're going to get a move up to the top end of this channel. And then when that happens, so that right now that's coming in about 106, between 105 and the 106 level. And when that happens, we'll see how price reacts, if we get rejected there or if it continues up through. And if it does continue up through, then basically what that means is that this above line, this line that I have on the top side is not legitimate, and I'll have to change it. Or it means the near-term trend is just generally changed, and I would have to adjust to that. So what right now, though, I'm not so sure, because we have an oversold ripple oscillator here. The tide trend line is, yellow. It hasn't turned to green, and in spite of the fact that we got a couple of green candles, we didn't get a green candle on today's price action. And so, even though we did close above this trend line, I'm not convinced about it. And I suspect, my guess, if I were to guess, I think price is going to come up a little bit, maybe into Monday and Tuesday. But then once that CPI report is released, because like the CPI for next week is going to be, people are assuming it's going to be higher, a little bit higher than it has been in recent months, because for a lot of different reasons, but that's kind of priced in. So if the CPI report actually surprises to the downside or is in line with expectations, then I think that the dollar is going to get sold after that. So that's kind of what I'm watching for, to see if that is what actually does in fact take place in the market. So I want to just take a look at the S&P for a second, because I want to call out that we are in a green zone on the long-term indicators, and although the candles are red and the tide line is yellow on the week, the yellow close, that is a warning sign. But what I do want to call out is, on a technical basis, you have this horizontal level, which was resistance and now is being tested as support, and has actually held above. You can actually see, as I zoom in, you can see that it actually has held pretty strongly. And so want to call that out. I think that's a bullish sign. So while the markets, especially the NASDAQ, coming off a bit the last couple of days, while it is coming off, I don't actually see this as being, I could be totally wrong. It's kind of, I have kind of mixed feelings about the markets, because if I look at the S&P, it looks fine. Honestly, it looks like it could continue to move to the upside. But when I look at the NASDAQ, I've got some caution here, because you can see this red triangle that signals exhaustion. And it turns out that when you see that signal on the NASDAQ, that's a pretty good spot to close longs and maybe take shorts if that's your prerogative. But the only thing is now here is, while that signal has been good in the past, the problem that we have now is that the other, like I said, the S&P is holding support. The Dow is, while it hasn't made a higher high, is also holding support. You can see the colorful tide line has been holding that line for some time, and it is in green zone too. So, and then the Russell kind of is similar to the NASDAQ in its exhaustion structure. You can see, if when I come back, you can kind of see it back in August. But still, like, more bullish dynamic. So I'm just not ready to say that this, and I've been pretty bearish. You guys know, if you've been watching, I've been pretty bearish for some time, but I have a hard time being super bearish even at this spot. And people might say, well, hey, if yields are going to go up, then asset prices have to come down, and that's actually not true. And the reason why is, if you look at, let me pull up TL. No, let's pull up IEF. That'll be a little bit better. We're going to pull up IEF, and we're going to go back to the post-COVID era, or just immediately after the COVID era. And what we'll do is, we're going to put the SPY, and we're going to overlay it. And what I want you to pay attention to is, in 2020 and 2021, the orange line here, look at what the S&P does, and look at what IEF does. And IEF is the bond proxy. Bonds are going down while assets are going up. And so, and then you notice too, in the crisis, when stocks were coming down, bonds were going up. So I highlight this because a lot of people have only paid attention to the fact that just in 2022, the bond market and the equity indices have been basically going up and down together. And that's actually not normal. It's actually the reason why the 60/40 portfolio worked is because this is what you typically would see. If stocks were going up, then bonds were going down, or if stocks were going down, then bonds were going up. And so that's more of what we're seeing, what we have seen traditionally. And I suspect that potentially because of possible recession fear and otherwise, I think that this correlation is breaking. I think that it's going back to its inverse correlation rather than to its actual correlation. So for that reason, I actually think we're in a situation now where bonds can sell off, but assets like equities can actually go up. And so I think we all need to be prepared for that play to continue. Because like if you look at like the bond ETFs, we're going back into red here. So that's IEF. Let's look at TLT. Let me actually go to my watch list that I normally would be looking at. TLT also transitioning to red. TIP transitioning to red. Like all of this is bad for bonds, and yet here we are with SPY green on the overall market condition. Even though again I know the candles are red, but the tide line is green and the market conditions background is green. The Nasdaq is the one that is kind of the laggard here, but then you go to IWM, green market conditions, and the Dow green market conditions. Again, even though the candles are red, the candles can be red and price can still be ultimately bullish. Typically, like when you have the green background here, then you actually want to be a buyer when price pulls back and the candles are red, because as long as the background stays green, that's showing you the overall condition is actually more bullish than it is neutral or bearish. So I just want to call that out. So let's just take a look here and look and see if we can find some opportunities here. My process typically is, in this kind of situation when you have, let me just use IEI, which is a 3 to 7 year bond ETF. My process is the best places when you're in a red background, when you're in bearish market conditions, the best place to actually place orders is when price comes back up to the tide line, which is the colorful squiggling line. And if market conditions are red and bearish and price were to say come up not just across the colorful line but also across the gray background line, that's an even better place to buy. And then the converse is true in bullish situations. So if we go, let me go over here just as an example because we're using IEI as the example. My process once again is to follow this when price comes back. Like this is what I'm talking about. We have green background and price has been actually like printing red candles. Those are the best places to buy. So so that's kind of been my process, and I just want to call that out. But in this case, even though that's kind of where things are at, when market condition is red and the candles are red and the tide line is red, then it's kind of too late, and it's not really a safe entry. So you want to just hold off. So as I just look through, I'm just going to pop through some of my ETFs here and look and see if I can find some opportunities. Actually, the commodity index looks like it wants to pop back up into a value zone. So I'm going to be watching DBC to see if price comes up into this line, and if we can stay in red in bearish market condition, then that's going to be something I watch for. So I'm going to flag that as a potential short. Uranium looks pretty good. You can kind of see what I'm talking about here. The red, this is a really good example in action. We've got the red candles within a green market condition, and price has been just coming up ever since then. And obviously we're testing a really important long-term trend line, and so I do want to call that out. So uranium is a good thing to be in. This is another uranium ETF. Oil, this is actually a good short opportunity here. My conviction here on oil is that we're actually going to come down on crude oil for one more dip, and then it's going to be time to go long. And I'm willing to wait for, if I'm wrong and this doesn't come back down, I'm willing to allow this to turn green and then wait for the pullback to take the long position. I can be patient for that. UNG is pretty bearish here. And natural gas, talk about something that's extremely hated. I actually think that we're bottoming here, and I think that natural gas is poised to make a a move higher. If not, like, I'm not saying that we're going to like break out and go to, new highs or whatever. I'm not saying that we're going to go back up and get up to 35 on UNG, but at least we got to get up into this area. So that's the kind of play that I'm looking at right now. But that's kind of risky. DBP, precious metals. Here's an opportunity for a long trade here, possibly. You can kind of see, again, green market conditions, and price has been kind of just resting, consolidating on the tide line. And so that's going to be some action that I'm looking at going into next week. Agriculture, no play here. GLD, because of DBP, then you're going to see GLD and not SLV, but GLD is actually poised for some positive price action. Miners look like there's nothing actionable here. Bito, nothing actionable. China looks actionable here. So I've already got that tagged because I tagged that previously. But again, see that same kind of setup right there. It looks like a good spot. Emerging markets, same kind of setup as China, so we can actually flag that green. Eurozone, not quite as good of a setup. Want to wait for that to come back, so no play there. And then UUP, this is again the dollar tracking fund, and I'm not quite ready to say that it's actionable to the downside here. I'm actually waiting to see price come a little bit higher before I take a better risk to reward position to the downside. And of course, like if the market condition changes, then that's going to be something that has to change my thesis on that. So that's kind of what I'm looking at. So the opportunities are DBC to the short side, DBP to the long side, FXI and EEM to the long side. So hopefully that helps. Hopefully that gives you a good analysis. And thank you again for tuning in. Make sure you hit that like button and share this video with somebody. And just a little programming note. Next weekend I will be out of town and I will be unable to post an update, but I will do a special video next week looking into the CPI report and some reaction for that. So that video will either be Tuesday afternoon or will be Wednesday afternoon. So stay tuned for that. Again, no weekend video next week. If you are subscribed to my newsletter, you'll see the newsletter on Sunday. And with that, I hope you guys have a solid weekend, and I'll see you guys next time.